Hi, everyone. This is John Graham. I'm a finance professor at Fuqua. I've been a professor at Fuqua for 27 years now. And during all 27 of those years, I've been running Fuqua's CFO survey that I'll tell you about in just a moment. I'll tell you about our latest results that came out in June. Now, we'll do some Q&A at the end. If you have any questions as I go along, go ahead and type them into the comments section. So let me go ahead and pull up my slides now. All right. So this is the CFO survey. This is conducted jointly with the Federal Reserve Banks of Richmond and Atlanta. I'll tell you more about that in just a moment. I should say that these are going to be my views, not the views of the Federal Reserve Bank when I talk about interest rate policy and such towards the end. So each quarter, we conduct this survey since July of 96, so 27 some years now. As I mentioned, jointly with the Fed, the last 3 years only. I'll talk about the June results here in just a moment. We have a panel of about 1,000 CFOs, and each quarter about 350 of them respond, which is actually a really good response rate in today's world. A lot of them are repeat responders from quarter to quarter. So we can tell when a CFO changes their mind and not just, a different set of CFOs responded this quarter compared to last. So we can really chart changes in the viewpoint of CFOs. The CFOs tell us their information anonymously, and we never report an individual company's information. But what we do is we take a weighted average of all of these different, all the bits of information from all these different companies to get a sense of where the overall economy is going. Okay, and down towards the bottom side of the part of this slide, this is an input that some central banks and other sources use to make economic decisions, including the Federal Reserve Bank, although, of course, they consider quite a lot of other information too. And Fuqua really likes doing this survey because we view it as really practical, applied research that brings us closer to the practice of finance in both our teaching and research. Now, you might ask, why CFOs, right? Do they have a crystal ball and they can tell the future better than anyone else? No, not really. But companies make business plans, okay? And it's what CFOs are telling us, and for a number of these questions, is really just the number out of their business plan. And as long as those business plans more or less come true on average over the next year, then we get a good future look at what might happen over the next year, okay? And companies, certainly world events can change, and companies change their actions relative to their business plans. But generally, companies try to sort of stay on track, with their business plan. And so it does produce a reasonably good forecast of the next year, maybe next 2 years, which is all the further out we're really looking with this survey. Now, this little graph that hopefully that you can see on your screen shows the relation between the optimism that CFOs have about the U.S. economy and the unemployment rate 1 year later, okay? And that's a really tight statistical fit. If you remember back to your stats class from Fuqua. Here's another graph that shows when companies say how much they're going to invest capital spending over the next year compared to the actual capital spending that occurs over the next year. And again, that's a very good statistical fit. So it looks like the information CFOs provide from their business plans does do a pretty good job of predicting the future. So that's why we talk to CFOs. But let's move on now and start talking about the results, okay? There's really 4 main types of results in the survey. And the first are these optimism indexes that we have, okay? Now, we have 2. One is in red, where we ask CFOs, tell us about your own firm's financial prospects. How optimistic are you about your own firm's financial prospects? And in blue, we also ask in parallel, how optimistic are you about the U.S. economy? And you can notice the red is almost always greater than the blue. So their own firm prospects, they're more optimistic about that than they are about the overall economy. And I think what that reflects is that companies have this business plan, even in sort of bad times or uncertain times, like I described right now. We're in very uncertain economic times, okay? They're not sure what's going to happen with the economy in blue, but they have a plan to help them navigate so that their company performs well over the next year, even given the current economic circumstances. So that's why we have the red higher than the blue. But out there on the far right, the most recent survey from June of this year, we see quite a gap. So this reflects quite a lot of uncertainty about the US economy, but still companies are feeling pretty decent, modestly good about their own prospects. Now, it just so happens we started this survey this quarter the last week of May, and the debt ceiling situation was still not resolved then. And then around June 1st, that got resolved, and we kept the survey going for another week or so. So about half of our sample is from before, and about half is from after the resolution of the debt ceiling situation. So the B, that means before. The optimism was down, actually, kind of notably, before the debt crisis was resolved. And then after the debt crisis is resolved, really, it's kind of ticking up a little bit. And we see that for both the overall economy as well as their own firms. So if we only look at the information from after the resolution of the debt situation, the government debt situation, we do actually see a bit of an improvement in optimism. So that's, I'm going to call that modestly good news. You're going to see it's going to be tempered with some not quite as good news. But still, that's the first bit of information. The second type of information that we have is what are the pressing concerns that CFOs face. So we have a question where we ask, what are the most pressing concerns for your business? Blank. And then they type in what those pressing concerns are. And so by doing it this way, typically if you do this on a survey, you get 100 different answers, and none of them really aggregate up to a lot of companies worrying about anything in particular. But on this survey, we actually find quite a lot of concern about this top row here. So in dark blue, that's the result from this quarter in June, and the light blue is the result from the March survey, the previous quarter, okay? And what we see is that the number one concern is about hiring and retaining the right employees for their firms. Now, companies have been concerned about this for a long time. It's been number 1, 2, or maybe 3 for more than a decade now, in good times and in bad times. And so in a way, at this point, it's not surprising it's number 1. But if you think about it, this is an ongoing, really important issue for the U.S. economy that we haven't resolved yet, okay? And so companies are still concerned about it. And I think it's one reason why companies are still hiring, even with this uncertainty, and not letting people go very much, even if their industries may be struggling a little bit, because they're finally hiring the employees they want and they're holding on to them. Number 4 here, cost pressures or inflation. We see that last quarter in light blue, that was number 2 and quite a concern, but that's fallen off, okay? So one of the themes today will be companies are a little less worried about inflation now than they were even just last quarter, okay? And then we see monetary policy and demand, just kind of weaker demand is coming in as number 2 and number 3. We wouldn't have heard about these if we went back 2 years, 4 years, 6 years ago. These weren't even on the radar. So it's notable that they're now sort of top concerns. Okay, that was the second kind of information we get from the survey. The third type of information we get are really numbers from the financial plan, if you will, numeric estimates of how much will your revenue growth be in 2023, that's in dark blue. How much do you think your revenue growth will be in 2024? So this is one place we do ask them to reach a little bit further, like 18 months, as much as 18 months out on the current survey. Here we see these are medians, okay, rather than averages, because averages, as you recall from statistics, can be affected by outliers. Now we do things, we take weighted averages and stuff to make that minimal, but you see the averages jump around a little bit more, and the medians are kind of more stable, and I think give us a really good sense of where things are heading. So the median expectation is about 5% for revenue growth. Now, keep in mind, inflation might be running at about 3% over the next 18 months. That's my guesstimate. And so that's about 2% real growth. That's really not that great. It's positive. That's good. In other words, it's better than inflation, but it's not setting records. Okay. So we do expect growth, but not records. Maybe even a little more interesting, how much do companies expect to raise the prices of their own products? In light blue, we see next year by about 3%. The unit cost here is their input costs. So input costs have gone up. They're estimating for this year what's already happened for the first half of 2023 and what they expect to happen for the second half, average together. Input costs up by about 5% this year, but only by about 3% next year. And on the far right, the wage bill also showing less price pressure. Okay. And so this is, I would characterize it, given the current circumstances, as good news overall, that it looks like the inflationary pressures are going to ease a little bit. Again, I don't represent the Fed here, even though we do the survey with them. We gather the data with them, but we each have our own interpretation. So John's interpretation is this might help the Fed be a little less concerned about raising interest rates. I mean, they may well still do that a little bit in the second half of the year, but it seems like maybe it'll be tempered, right? Kind of good news. Now, by the way, I don't know about you, but I'm still waiting for that 5% hike in my wages this year. It hasn't quite come in, but hopefully some of you will have a little better luck than me for your own personal wages this year. Okay, and employment growth is actually also going to come down a little bit. Now, we want a lot of people to be hired, right? But when your unemployment rate's 3.6%, you can only have so much employment growth. And a little bit of softening in employment, as long as it stays positive and we're not having mass layoffs, might be an okay thing for the economy too. Another sort of numeric piece of information that we gather is about GDP growth. So this is real GDP growth. This is net of inflation, okay? And if you look down here in the bottom, that top bullet, that this quarter survey from June, the 1 year ahead GDP, so the second half of this year and the first half of next year, CFOs think there'll be about 1% GDP growth. Not negative, so they're not calling for a recession, at least not averaged over those 4 quarters, but they are calling for not very robust growth either. Last quarter, so even in March, we heard 1.4%. And so it's a little bit softer than last quarter. Positive, which we'll put a positive spin on that, but not robust GDP growth. So it has been an issue out there. Are we going to have a recession? Are we going to have a recession? CFOs don't seem to think so. Now, if you look at this chart on the top, this question is kind of involved. So I'm going to just take a minute to explain it to you. I hope it's not too confusing, but if it is, don't worry, we'll move on to the next slide shortly. The way we ask this question is we actually ask CFOs. Hopefully you can see my cursor here moving on this part that says minus 3% to minus 0.1%. CFOs, what probability do you assign to growth being over the next 12 months between minus 3% and minus 0.1%? They assign about a 20% probability to that. Well, what probability right here in the middle of the distribution do they assign for growth to be just slightly positive between 0 and 1.4%? That's about 28% probability. And about a 25% probability growth will be between 1.5 and 2.4. What we do is we take a probability weighted average across all these possible GDP growths, and that's what gives us the 1% average I mentioned before. So that was a little long-winded, sorry, but what you can tell from the graph that's kind of nice is you go from light blue last quarter to dark blue this quarter, a shift to the left of the distribution a little bit. That's where we're seeing the expectations have fallen a little bit kind of across the board. And if we add up the dark blue here for the negative growth, there's a 24% chance, you can see on the very bottom here, that CFOs assigned to negative growth this year. So not a recession, well, a 24% chance maybe of something like a recession, but still more likely that we'll have positive growth. All right, moving along. The fourth type of question we ask are what we call, they're rotating. We call them the topical issues. What's a kind of an important issue right now? Okay, what's been going on? The Fed has been raising interest rates from close to 0%, the federal funds rate, to about 5%. So interest rates, by some measures, have gone up by as much as 5%, okay? is this finally going to start affecting the economy? What is the Fed trying to do here? They're trying to slow down economic growth a little bit, and in order for price pressures to fall, for inflation to fall. Okay. Now, we've asked, and what we're asking companies is, since interest rates have gone up so much, is the cost of credit, that is the interest rate you pay, or the availability, your access to credit, the current situation, is that constraining your company's spending slash corp capital investment plans? Okay. Now, we've asked the same question for many times over the last, say, 15 years. But over the last 15 years, interest rates have been low for quite a long time. Okay. And we always kept hearing, no, not really. If the Fed, we would ask a question, if the Fed raised interest rates by 3%, which seemed like a lot, will that affect your spending plans? And companies would say, no, not really. Okay. Well, guess what? Now rates have gone up by 4 or 5%. So we're asking once again, in the current credit market situation, is that constraining your behavior? And what we see here, over here on the left part of the graph, 31.5%, we'll call it 32% of small firms here in this kind of brownish color say they are currently having their spending or investment plans constrained by credit markets. And about 19% of large firms say the same. Our definition of large here is a company 500 employees or greater. Okay, that's what we mean by a large company. We asked a similar question: by year end, do you anticipate that the credit market conditions will be constraining your investment plans? And here we get about 38%. So if we go with that number, 38% of small companies expect that their investment will be constrained by year end, and about 24% of large companies. Now, is the glass half empty or is it half full? Well, I actually think this number is reasonably big. It's way bigger than anything we've heard in the last 15 years of companies being constrained, and or even expected to be constrained if rates were to go up. And that's starting to be a measurable effect on the economy. I think that's why we're seeing slower growth now, and why revenues are only expected to go up 5%. And other objects of study, we're seeing moderate okay growth because a decent portion of the sample now is being constrained. So that's interesting. What if we look at the portion of the sample that is being constrained? So if you average large and small together, it's about 30% of the sample say they're being constrained. Well, how might that affect a company? Maybe they can't pursue new investment. Maybe they cancel or postpone current investment. Maybe they can't even repair or replace existing investment, etc. So we asked a question like this, and far and away, the number one response is it's constraining our ability to do new business investment. So the good news of that answer is they're still more or less proceeding with what they're doing. At least the majority of companies are, even in this constrained sample. The bad news of that answer is that they're not investing now. They're not going to be hiring 6 or 12 months from now to fill that new plant they might have otherwise built. And so I think this means that the effects we're feeling now are going to kind of drag out a little bit into next year, even if companies start ramping up investments, say first quarter of next year. It takes a little while to get the engine back running full speed. You can see here, by the way, large and small companies, those that are affected, pretty similar answers. About 40% of small companies say that they don't think they can refinance their investment given current interest rates. They're not able to or not current to. Another almost 40% say replacing or repairing existing capital assets is an issue. That's a little bit worrisome, to be honest, but thankfully it's not more than 40% of small firms and roughly 30% of large firms. What about that other 70% of the sample? Why aren't they constrained? Interest rates have gone up so much. And I think this is an interesting and important thing to be aware of too. A lot of companies, small and large, who aren't constrained say, we've got enough cash. We have enough internal profits or accumulated cash from past profits that we're doing okay. For large firms here in the lighter blue, a lot of them are saying, we just don't use debt to fund our investment. Or a lot of small and large together are saying, we don't really need to expand right now. So investment is really not an issue, and the credit markets aren't really constraining us. So here we do see more similarities again between large and small, but we kind of understand why they're not feeling credit constrained. Okay, one more slide. Summary. Um, the debt ceiling, that was just happenstance. We didn't really set out to ask about the debt ceiling, but the timing of our sample let us understand that resolving the debt ceiling was actually an important outcome and a good thing for the economy moving forward. I know there's all the politics and everything behind it, but at least for the economy over the next year, CFOs are saying this is a good thing. The outlook for the own firm is, I would call it moderate. Maybe moderate's even a bit too strong of a word, but we are on the good news side seeing falling price pressures over the next year. GDP outlook is slightly worse, but CFOs are not calling for a recession. Hiring and retaining employees is the top concern. I mean, there's got to be some branch of consultants alumni out there right now who deal with these issues and can hopefully help companies resolve, maybe through training or I don't know what, help resolve some of these issues about having the right skill set employees. And finally, higher interest rates are finally constraining investment. I say finally because we've been asking the question a long time. And now we're seeing results of these higher interest rates. It's not great that it's constraining investment, but it was the goal to tame down the economy a little bit so that inflation will fall. But probably not the intention to hurt small firms more than large firms, but that does seem to be what's happening. Okay, I've got this thing here in red. If you know of a CFO who might participate in this survey, or if you're a CFO, please send me your information or contact me on the side, and so we can enlarge the sample of our survey. All right, why don't we? I need to switch screens here, but we'll switch back over to the questions that we might have here. All right. Well, one question that we've got is, why isn't investment more interest rate sensitive? What that means, remember I said when the interest rates were low, and we said hypothetically if rates were to go up by say 3%, why won't companies be affected? Or even now, why aren't more companies affected after rates have gone up 5%? One thing that companies do, we know this from other surveys, not from this survey, is they set a hurdle rate much higher than their cost of capital. So the cost of capital, you might remember, we take a weighted average of the cost of debt and equity. We call it the weighted average cost of capital. If companies can out earn that, they should be creating value, okay? But they set a hurdle rate that's maybe 5 percentage points higher than that. So even if the cost of debt goes up some and raises their cost of capital, companies don't change that hurdle rate very often. And so it takes quite a lot of interest rate hikes before they really raise the hurdle rate and it starts affecting investment. And I think that's why it took so long for this to kick in and the Fed had to raise rates so much. Goes in reverse too, right? When the Fed starts reducing interest rates, the hurdle rate doesn't just drop down that fast. And so there's always a sluggish response. All right, okay. I got one person said they are also waiting for the 5% wage hike this year. I think a lot of the wage hikes have been going more to people-facing industries and quite honestly, kind of on the lower end of the pay scale. That's kind of a good thing if that's the concentration of the higher increases in wages as far as kind of reducing the inequality of income and such. But yeah, those of us with white collar jobs, maybe on the upper end of the spectrum, we're not getting those bigger raises. But okay, are small firms considering diversifying customer base to decrease vulnerability? Okay, we didn't ask that question, and so that sounds like a pretty logical possibility there. Something companies should do is diversify. What I've heard in past surveys when we ask about this type of question is kind of the first thing companies do is double down on keeping their current customers happy and meeting all their customers' needs. I mean, you always want to do that, but retaining your current employees and making sure they're happy and might stick with you and ride out the wave is probably one of the top things they're doing. If you're able to diversify now, sure, diversify into a good sector, that sounds like a good plan also. But if there's any costs or risk with that, companies might have a little hesitation. So I don't know for sure if they're doing the diversification of customer base, but it certainly seems like something that they should consider doing. One other question that came in was when I talk about averages, I said there's some kind of average growth or something coming. Like, are big firms getting more weight than small firms? Because if you think about it, big firms, small firms are important, and there's a lot of small firms. So you want a lot of small firms in your sample in order to represent the economy, and we do. But if all small firms if one small firm increased employment by 10%, that means a lot less than if Walmart increases employment by 10%. So when we take our averages that I've been expressing today, we do either a revenue weighted, where a large firm will get more weight, or an employee weighted. So again, a large firm, as measured by number of employees, will also get more weight. And so that helps us be more representative of the aggregate economy. So small firms are important. We've got them captured, but large firms do get a little more weight when we do our averages. The Fed, someone asked a question about, has the Fed raised rates this rapidly in the past? Not this rapidly for a very long time. The last few times the Fed has raised rates, like you probably heard about, if you go back, how long is it now? 45 years ago, back into the early 80s, the Fed raised rates like crazy. But after that, so in the last 40 years, the 2 or 3 episodes where the Fed has raised rates, they've rarely raised them by as much as 5%, and usually spread over a longer period of time. So the fact that it's been really concentrated and really fast is notable, okay? And it's really because the Fed thinks things were starting to get out of control, okay? They were, in terms of inflation, that is. And so they really there's 2 things. One, they want to slow the economy, but 2, they want to let the world know we're serious about this, okay? We're taking this seriously, because the voice of the Fed itself matters. Now, let's say we're working at a company. We're thinking about how much we should raise our prices of our products and our plan, or this or that. If we believe the Fed is serious about reducing inflation, well, we might not think we have to raise our prices quite as much to sort of keep up. But if we think inflation's spiraling out of control, then we build in a bigger price change ourselves, and it kind of reinforces higher inflation. The Fed wants to break that reinforcement. They want us all thinking, okay, prices have gone up a lot, but now we're rounding the corner and everything shouldn't go up by as much. So I shouldn't pay as much for a new car. I shouldn't pay as much of an increase for a new car or a new house. And they think that will kind of pull back the expectations of inflation too. So anyway, they've raised rates super fast, super high, relatively speaking, which is very unusual, but because they're trying to get our attention and trying to really tighten things up. All right. Well, I think that about does it. Once again, if you know of a CFO who you think would participate, look, CFOs retire and such, right? So we do lose people from our samples. We always need to replace. So we're always looking to add more CFOs. But other than that, I hope you all are doing well, and I hope to see you in person sometime on campus or in some other means. Thank you. Tune in next month, August 2nd. We'll do our next LinkedIn Live. And again, I'll say goodbye now. Thank you.